For more on what the Fed may do next, let's bring in former Cleveland Fed President Loretta Mester. She joins us now. She's currently an adjunct professor at Wharton and a CNBC contributor. Loretta, great to have you with us.
Thanks for having me, Melissa.
Are you on board? It looks like the markets are pricing in with a high probability, when I say that, above 50% of three cuts this year. Do you see that?
So I think the Fed's in a difficult position. I mean, as Steve Leisman just pointed out and the chair said today, right, the tariffs affect inflation and they affect growth and employment, the other part of the mandate. So the Fed's got to play this very carefully. They don't know what's going to end up happening later in the year, and I think that's what the chair said, right? So for now, we know that we're going to see prices rise from the tariffs. It's the Fed who can prevent those one-off price increases from becoming embedded in inflation, and that's what I think the chair was trying to say, which is, look, we have to keep our eye on inflation expectations and not allow those to rise, because that's the mechanism through which those one-off price increases from tariffs could morph into more persistent inflation. So I think he's right to keep his eye on that now. And then when the further information comes out and we see how the economy is going to be reacting, we'll have a better sense of how much the downside is in terms of growth and employment, and the Fed can react then if they have to, if necessary. Remember, there's also other policies that are affecting the economy as we go forward as well. We have the tax cuts, and we don't really know what that's going to look like yet. We have immigration, which is going to be hurting the labor force growth, so that's also a negative. So there's a lot happening in this economy. There's still a lot of uncertainty. And I think what the Fed needs to do is keep its focus on both parts of the mandate, make sure that it doesn't allow the one-off price increases that we know are going to come with inflation to become more permanent. And I think that's what the Fed's job is. And the chair said that today, that it's their responsibility.
Hey, Loretta, it's Tim. Thanks for joining us. As you look to rates in 2026, Steve said that the rates market, the market itself, priced something in for the Fed, and there can be some conjecture whether that was a lot or a little. But as you look out to next year, and I look at Deck 26 Fed Fund futures, we're somewhere around 290. Which tells me that the market is certainly expecting a lot more to happen out in the next year. And I guess this feeds into kind of just your own medium-term expectations based upon what we have now. Not what we think the Fed's going to do, but I'm curious how you're viewing this.
No, I think that, if the Fed can do what it needs to do now and sort of make sure those inflation expectations remain anchored, we're going to see temporary rises as inflation, but they'll come down as the economy digests the price increases. So prices will end up higher, price levels, but the inflation rates will come down. And then I think the Fed can start to bring down the Fed funds rate. I don't think they're going to be able to do as much as the market is anticipating, but I think they'll look out and see, okay, we have seen some uptick in unemployment rates and we have seen growth slow down. And so it would be the reasonable thing to do to start bringing the rate down. That would not be the same reason that they were going to be bringing rates down in the middle of last year where everything is working well and we get the soft landing. It really would be because growth has weakened, the labor market has weakened, and so we'll have to see some change in the Fed funds rate. But I think that is a way off. I don't think it's going to be as soon as the market is anticipating, and I don't think it'll be as much as the market's anticipating. But we don't know because we have to let things play out some more to see what the real effects are. And we don't even know whether some of the tariffs are going to last at the levels that they've been put on at this point. So there's a lot of uncertainty around all of this. And I think the Fed is right to sort of point out the uncertainty. And, great that we got a good job report today allows them to have that more chance to be strategic and assess things and be patient.